Welcome back to the insidious world of the ARK ETF Trust, or as it's most commonly known, ARKK. So, who doesn't know about this one? It's Cathy Wood's most popular investment vehicle, the ARKK ETF. And as you can see here, it's been going down and down and down every day. And you can see the performance returns over here in 1 year performance minus 50%, 3 month performance minus 43, 1 month performance minus 30, 31. Basically, it's a disaster over here. You'll see that the highest it has gone is 161, and right now it's almost 1/3 of that. It's like insane. It's 65. So I wanted to examine this ETF and see whether it's a potential buy, or actually see why it's going down and whether we could expect it to revert at some point, reverse course. And so I have talked about this ETF before, and a very, very important thing to do with this is actually examine the holdings, the core holdings that are behind this ETF. And when the market is flying, it's easy to think that this is like the next big thing and it's gonna go up forever. But that never happens, especially when you're getting very, very leveraged investments for your portfolio. And you will see that this is the case for this ETF. And so this one is actually currently having a short interest, which is more than 10%. Always a bad signal. It's 16% right now. And I'm assuming it's growing. Yes, it is. It's growing massively, actually. So people want to short these stocks, basically. And let's take a look at the holdings of this. Obviously, you can see, and you will see here, that this is a very, very nice chart that shows the amount of holdings, the holdings weight, and the performance of its stock. You will see that this ETF is mostly about Tesla, a lot of Zoom, T-Doc, which is Teladoc Health, and Roku. So these are some companies that are, generally speaking, very overvalued. And let's take a look at what they're doing. So Tesla is probably the one that kind of keeps holding the ETF together, and it's very, very overpriced. I mean, we can take a little bit of a closer look, but you will see here that Tesla is down the last year for 1%, which is okay. I mean, that's not a big deal. But look at this, Teladoc Health, 75% down. Zoom, video communication, 62% down. Roku, 62% down. Keeps going on. Coinbase is very new. It's not 1 year old yet. I'm pretty sure it's down right now. We can check it. But Exact Sciences Corporation, I don't even know what that is, 50% down. And Unity, 40% down. That's insane. Spotify, 47% down. I mean, look at that. The highest weight, these are like the top 10. They're all down, like massively. UiPath, I don't know what it is. Only Intellia Therapeutics is up 44%, and Twilio, 48% down. These companies are doing really, really bad. And we can take a look individually, like T-Doc, for example. Let's take a little bit of a closer look at what Cathy Woods is buying and why is she buying these things. So let's take a look at the overview of this company. Look at that. It doesn't even have a forward P, not just a PE. And look at these values here. It's like insanely down, like 75% down in a year. And this is like her second top holding. That's absolutely insane. And the company doesn't have a PE. Granted, it has a low price to book ratio. That's probably because it fell off a cliff. But let's take a look at this company's cash flow statement. Let's see why is this company not making money at all. Let's actually take it to the last 5 years or so. So look at that, the net income of the company going down and down and down. And I'm pretty sure there must be financing with debt. Yeah, lots of debt, total debt issued here, issuance of stock. You would expect that. Free cash flow, look at that, minus, a little bit of a gain here, then minus again. I mean, this company has a $10 billion market cap and it's not making any money at all. And what about the growth here? at least it's growing its revenues. That's a good sign. Although even with growing revenues, they cannot still make money. Like they are growing the revenues and they are losing money. That's absolutely insane. I'm assuming they have a lot of capital expenditures selling. Yeah, look at the costs here. They have to bring down costs massively, selling and general and admin expenses. That's absolutely insane here. So they're losing a lot of money. And what about the debt situation? Yeah, they don't have much debt yet. But it's insane that her second top holding, Cathy Woods, I mean, her second top holding is like 70% down, 75% down. It's absolutely insane. And if I actually go back to ARKK here, the fund, and examine the holdings here, you will see that everything is in the red. Everything that she has picked, regardless of sector, is actually going down and down. And Zoom, for instance, we can take a look at Zoom. But the thing that I wanted to mention as well, look at the fund flows. In the last week, people seem to be buying actually, but in the last month, it's in the negative. In the last 3 months, minus 1 billion outflows. So as a as a total, so the fund flows is actually the total of inflows and outflows for the fund. And so $1 billion have left the fund basically in the last 3 months. Now, if you keep coming back in, just because I'm assuming it goes down, but it's a sketchy situation because these kinds of companies like Zoom, for example, let's take a look at Zoom. And Zoom is a company that I think is a good company, really. But I mean, I like the product, of course. But even at this price, it's slightly overvalued. I mean, it's not massively overvalued, it looks like, but it is still overvalued even at this price. Imagine this price where she was buying it. And let's take a look at Twilio, for instance, which is another of her core holdings here. What's going on with Twilio? Twilio doesn't even have a PE here, so possibly losing money. Look at this, like going down and down and down. Let's take a look at the financial analysis here and the cash flow statement of Twilio. Like, how can you invest in these companies just because they can potentially grow in the future? Like, look at this. Look at the net income, minus almost $1 billion here, and they're still investing a lot. But look at this financing here. Issuance of common stock is like full of issuance of common stock. Like they're diluting investors massively. Look at that. So why would you buy this company? And no free cash flow basically. But if we take a look at the overview here of Twilio, that would be exciting here. The shares outstanding, look at that. They keep issuing shares. It used to be 80 million and now it's 180. It's almost tripled, like 2.5x or so. That's absolutely insane in like 4 years. So they keep creating stock and selling it to investors that think that they're buying the next big thing. And just because the company was very high, they could actually use this stock to sell it at a very, very high value. So they kept on selling and kept on selling, and this is how they're funding their operations. They're not making any money. And at some point, this comes back to hurt you, because you have to start making some money. And this company went from 450 to 172, and future is looking bright. I mean, I don't like what I'm seeing here. It's the companies are not making any money. So let's go back at the ARKK. Look, I mean, we're examining the holdings, the top holdings, so that you get a sense of what Cathy Woods is investing in. Like, does this sound like good investments to you? If they do, I mean, more power to you. But let's take a look at Roku, another company which is potentially an interesting company for sure. But when we're talking about companies, you have to remember, a company may sound amazing and you may love the product, but we're not buying the product, we're buying the company when we're purchasing the stock. So we want to make sure that we're buying something that has a potential return on investment for our money. And how do we do that? Like, how would we know that we're buying something that has potential return on investment? The way we do that is we examine the company's financials. We need to know what the company is making. If we're spending $1,000 for a company that's making zero money, does that sound good to you? Like, what's the point of all this? Like, we need to be getting a company that's actually going to return money to us. And the thing is, yes, growth matters, but you can, but you really can't buy a company that's going to return your money in 10 years from now and claim that the value that you spent today is fair. Because what's the point of prepaying, like pre-ordering a company today in order to make this amount of money that you will make in 10 years, and it's gonna be the amount that you paid today? I mean, you want to make more, right? You want some return, and this is what we're doing in this channel, and this is what the software that I'm creating is actually and will be doing. Is going to be providing you some information on what is the fair value of a stock price to buy today, instead of actually think about it and be like, okay, this looks cheap, let's buy it. I mean, it doesn't work like this. Cheap gets cheaper in the stock market if it doesn't belong to the specific price. So if it doesn't do well, if the company doesn't do well, it can get cheaper. It can go here. Don't doubt that for a second. And so look at this. The current P is 72. The projected P is 148. I mean, that's insane. And let's take a look at the outstanding shares. What I would expect. They massively dilute investors. Like, who would actually invest here? Like, this is crazy. And let's take a look at the cash flow. Let's see. What about the income of the company? At least they went positive here. So they're in the black finally. But what's going on with the free cash flow? It's slightly positive. Okay, that's not bad. But the company is a $20 billion company, and it's making $200 million a year right now. That's an amazing multiple. It's like probably close to this one. And so think about it this way: you're paying $1 sort of to make. You're paying $178 for $1 of free cash flow, sort of. And you can do the exact calculation, but this is the core idea. Does it sound fair? I mean, it would only take you 148 years to make your money back at the forward P. That's not even the current. So, yeah, I mean, you have to think about all these things when you invest in these kinds of companies, because growth is amazing and it matters, of course, as long as the company has a clear path towards making money. And as long as they can actually manage their expenses as well, because it matters too. And the thing is, do you want to play the game of of a company potentially making it that far? Because if you buy, let's say, 20 companies or 50 companies, only one or two will make that that path, will actually make it. On the other hand, you can buy companies that are already making it and are undervalued. And this is what we're trying to find in this channel. And don't get me wrong, I do like growth as well, and sometimes it's beneficial to buy companies that are going to be growing in the future. But still, you have to be cautious about it, and you don't want to overdo it. You don't want to buy companies that are like a lottery ticket that could go well or could go bad. You could buy those as long as you know that you are trading those, or as long as you know that you are backing on the trend, and you are basically trying to find the next person to offload the stock to. That's how it works. Otherwise, you are investing in a sensible manner, and you are buying companies that are making good free cash flow and are growing nicely for the future. Hope you enjoyed the video. If you did enjoy the video, you may want to take a look at our Discord channel that I have created a couple of weeks ago or so. And you can find the link in the description below this video. And I'd love to see you there. We already have a few people, and we are discussing about all sorts of investment topics. So if you think the same way and you want to find nice investments and talk with like-minded people, come over, and we'll be glad to have you there. And thank you for watching the video. Please subscribe and like it if you did, and I'll see you in the next one. Bye bye.